favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Great, great. Let's get right to the disclaimer. What do you think?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right. What's the plan this morning, buddy?
So I think, we've been doing about, I would say for about a week, we were focusing on stock related data, mostly fundamentals. We talked about income statement, balance sheet, also cash flow statement. I think we'll go now to the options to mix it up, and we'll do the IV skew. So we'll talk about the skew when we're looking at options. There are two types of skew. One is horizontal, which is the implied volatility looks different based on the expirations. So as you go out in to more longer dated options, you're going to see implied volatility skew. We call it term structure. The one we're talking about today is a vertical skew, which is the implied volatility differences in the strikes within the same expiration. And what we'll do is use a scan to look for what I call an inverted skew. And then we'll look at an options chain as an example to see how those options line up and what that skew looks like. So we'll do that today. If there are any questions along the way, let me know, Will. And, I'm going to try to answer as many questions as we can before the end of the lecture. Okay. I'm going to share my screen real quick. Before we get started, we'll just take a look at what's going on in the pre-market hours. So this is the pre-market report, stocks trading in pre-market hours. We got the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm looking down here, 98 made our percentage gainers list, 35 on a percentage decliners list. So from that perspective, looks like a more bullish bias at the opening. I'm going to also take a look at the higher market cap stocks. So I'm using this filter market cap, stocks $20 billion market cap or higher. And I see 17 on the percentage gainers list, 10 on the percentage decliners list. These lists, not very big, not a lot of stocks on there, but slightly more favorable towards the bullish side, with 17 making the gainers list versus 10 on the decliners. Nothing's big's jumping out at me from these lists. So if there are no questions, I'm moving on to to the implied volatility skew.
All right, perfect.
All right. So when we talk about a vertical implied volatility skew, we're looking at options within the same expiration. And I'm just going to give you an example really quickly before I do a scan. I'll use Apple. I'm going to go to the options chain. And, this is the options chain. These are the different expirations. This one has 3 days to go. And we see that we got calls on one side, puts on the other, and we got all these different strikes. And these here are the bids and offers for the calls, bids and offers for the puts. And there are lots of trades. These are the volumes. So you see there are trades going on all these different option contracts that have different strikes. And that trading could push on a relative basis some of the options that are relatively more expensive or cheaper just because of the supply and demand, right? So you can see here the volumes for these strikes are different. And there are several reasons why there could be a skew. One is just because that's how the order flow is moving and pushing that skew. Another is just, how the market makers are looking at all the other markets around there. They have access to the, depth of book, order book. They see the flow much better because they're executing transactions, and they're seeing institutional order flow as well. But in a lot of cases, it will be the order flow that's pushing the skew. And one way to measure that skew we use the implied volatility of the options. And over here, we could see here's the implied volatility of the bid on this call. This is the implied volatility of the ask on this call. And as we go, up or down in strikes, we see that the implied volatility is different for each of these contracts. So here I'm just looking at implied volatility in Apple in the next 3 days, and we could see that it is increasing as we go up in strikes. So it's kind of like the opposite of what you usually see, because as stocks move higher, usually the implied volatility comes in for several reasons. Stocks tend to go up in a more orderly fashion, and you got a lot of people usually buy writing against their positions. So those types of things usually you see it the other way, but right now, the way it's lining up in the next 3 days, we see that the implied volatility has kind of been an inverted skew. It's going up as you're going up in price, and the implied volatility here, it's also increasing as you go down. So basically what it's doing looks like a smile. It's increasing on the wings. So one way is maybe we want to scan for a certain type of skew and then take a look at that options chain to see if there are any types of opportunities, that if you're looking for a certain type of skew, you want to first scan for it and then kind of do your research from there. So I'm going to use a scanner to look for an inverted skew. Okay. So no questions so far, Will?
No, you're good.
Okay. I'm going to go here under screeners, and we have options by expiration. And over here, we got a few filters up top. We got data table here below, and we got these different tabs. So I'm going to go to the skew tab here. And I already have a preset that I saved for myself to look for a skew to the upside. And basically, I'm going to come down. Let's go over some of these data elements. So here, we got the symbol, the stock price for this symbol, what the price have changed on the day. This is the expiration. So all these are this scan is based on, the stock and a particular expiration. So this is looking at the August 20th, 2021 expiration. This is the at the money implied volatility. This here is what the IV changed on a day from the previous day. Total volume in that expiration for this stock. So we can see here UFC didn't trade any options on this expiration yesterday. And then we kind of have a skew measure here. Now, to kind of measure the skew, we need to do a benchmark to see how much are the calls or the puts skewed. And one way to do it is take the at the money implied volatility and use that implied volatility and run it through all the options. Do a straight implied volatility to see what the options would be worth if we, for example, just use 22 vol, right? So when we looked at Apple, there was an at the money. What if we use that at the money vol and set that to all the options? Theoretically, what would each option be worth? Or we could see how much of the implied volatility then is on the upside call higher or lower than the at the money. So we have to compare it to something. We compare it to at the money. So here you'll look at a 25 delta put to see how much is it above or below the at the money, and then the 25 delta call. So here these are kind of a straight. There's really no skew there. And you could compare the 25 delta put to the 25 delta call to see if there's a skew there. So I'm going to use my presets, so upside skew, and I'll just go over what I selected up here. So here I'm looking at stock type common share. So I'm not going to look at the ETFs in this scan, just looking for common stock. I picked that the the stock price has to be at least $10 or higher, because really once you get to the very low price stocks, there's not that many, that the options don't really matter anymore because the stock is almost like an option. I'm looking at days till expiration. I want a little bit more than just, 2 or 3 days. So I'm going out, at least the expiration has to be at least 15 days to go or higher. I'm also looking at something that the implied volatility is at least 50 or higher. So looking at, higher implied volatility options. And I want the expiration to have trading. So over here, I'm saying that the option volume has to be at least 5,000 contracts on that particular expiration, right? Because I want to see some trading, because trading can present opportunities. Now, since I'm looking for an upside skew, let's look for the 25 delta call. So I'm going to just sort this and by highest, and I see here Wish, WISH symbol. That 25 delta call, it's looking at the August 6th expiration. Implied volatility is 123.2. If we run a straight skew and then look at the 25 delta call, the 25 delta call is trading at a 21% premium versus the at the money. Okay, so that's the upside skew. I also see that if I go to the 25 delta put, that put is trading at a 16% discount to the at the money. So what we have here is an inverted skew. As the strikes go down, implied volatility is coming in. As the strike prices go up, the implied volatility is increasing. All right, so that's our initial scan. So let's go to that stock symbol and see what's going on. And I'm going to show it to you on the options chain. We see that this is an August 6th expiration. So if there are no questions, well, I'm going to move on.
Yep.
So let's see what that looks like. So I'm going to go to Wish here. And before we look at this options chain, let's just take a look really quickly. What is this stock? So we see Wish. This is the stock. We can read about it. It's an online shopping store. Store provides personalized products, clothing, all this. So now we kind of have a sense of what this stock does. If you wanted to go to the website, you could click here and just see what they do. You could go to the investor relations website, all this. But if you just want to figure out what this stock does, because maybe there are similar stocks to this that you could also investigate it. Does it have the same skew, or the implied volatility is the same? What's going on? But that's one way to look at what the stock does. I'm going to close this, and I'm going to go here to the summary just to take a look at what's been going on in this stock. So let's take a look at the trading stats. This is for Wish. I clicked on trading stats, and here I see its performance. So this performance is looking at Wish versus SPY. But right now, I just want to see what this stock did. And it looks to me, it's like it's relatively new because we don't have 3-year, 5-year, or 1-year performance. So we see in the last 6 months, this stock is down 42.9%. It was as high as $32.85, as low as $7.52. So down 42%, almost 43% in the last 6 months. In the last 3 months, it's down 23%, but last month it made a big pop. So if we're looking at just the last month, it's up 43.4%. You see, it was as low as $7.52. It made it up to $15.18. Looks like that was the high in the last 2 weeks as well. And the last 2 weeks were down 11.9. So really quickly, I kind of just paint a picture what's been going on in this stock. Looks like initially, to me, looks like it was pretty high. Maybe it's new stock in the last 6 months, as high as $32.85. It's been on a downtrend, for the last 6 months. last 3 months. Then it hit a low, 752, made a big pop, right? It almost doubled from the low in the last month. Right now it's up 43%, but now it's backing up, right? Now we're back down 11% here, and we see yesterday, this is the range it traded in. So that's really quickly. Now I got an idea of what it's been doing. Let me go now to the options chain. And we're looking at, I believe, was it the August 6th expiration? Well,
Yep.
okay. So here I'm on the August 6th expiration. And this, this is the call side. And these are the call prices. And I see over here the volume. And this is just showing me that there's volume almost, it looks like, on every strike. Okay, so there's a lot of trading going on. And I could kind of even see here for each expiration, there's a lot of volume. July 9th expiration, 125,000 contracts, July 16th, 88,000. So there's a lot of volume. I see trading going on every expiration here that we have listed. And when I just go to the August 6th, I see that almost, a lot of these calls have trades going on. I'm also just going to take a look at the open interest really quickly. And I see that there's open interest almost on every line. So there's a lot of trading going on in here, which could present an opportunity. And that what might be pushing these skew, okay, just the sheer supply and demand and the imbalances of the order flow. Let me take a look here and find first the spot price. So the stock's around $11.89. This is the strike, 12 strike. This is the closest to at the money. So I see here implied volatility of the bid, 123, implied volatility of the ask, 126.4. As I'm going up in strikes, okay, so you see I'm going up in strikes from 12. Right now, you could go up to 25. I see that the implied volatility is increasing as I'm going up. From 123, you can see all the way to the 25 strike, 192 volatility. All right. I'm also just going to take a look at the downside puts really quickly. If I start at 12, we start out again around 124, 125 volatility. And you can see the implied volatility is decreasing as we're going lower. So just looking with my eye, what is the market really telling us here? So it's telling us two things, what it thinks could happen to the stock. One is if the stock increases, there could be a bull attack. So you know how you have bear attack where the stock's decreasing and you have bears just pummeling it down really quickly? Here, it's almost like a bull attack where if it increases, we could see a very accelerated move to the upside.
Yeah, just reading a little bit about it, it seems like it's in the whole Reddit world. Like people have been talking about it.
And that's what we've been seeing, right? Where the Reddit world has changed kind of, and I'm seeing this more and more. It's changing the skew to the upside because now we have something new where the bear attacks are usually done by hedge funds or institutions that could short, right? They're able to borrow, they're short. This is like in reverse where you have a bull attack. You have so many retail investors that in aggregate, they become a big force, right? And what will happen is if there's not enough supply of stock, you probably can't short it because it looks like it's a relatively new stock. It's not been out that long. And if it busts through, any of those resistance, you could see, that this stock could really fly. And we've seen it, we've seen it in AMC. We've seen it in GME. That was kind of like the one that really, paved the way. And then we've been seeing it in other stocks. So we see here that according to this, that's what we're looking at, that potentially if you get one of those like bull attacks you could see a really big increase. And look, we're looking at something 23 business days to go, August 6th, right? 23 trading days to go. The 25 strike is 110% out of the money. That's how much it's out of right now, out of the money. You got a 45-cent bid in that option. And you see that there's volume in it. There's 6,270 contracts open on this line. And you see it's trading. Not a lot yesterday, 83 contracts. And you could see, these are pretty small size contracts, 1 lot, 3 lot. We got a 10 lot here. But in notional terms, we're looking at, the biggest trade is $600, but they start adding up because if you have enough retail customers coming in aggregate, they're going to add up. So that's kind of what we're seeing to the upside. To the downside, what it's kind of indicating to me is that since the implied volatility is decreasing from the at the money, that if it goes down, we're going to see a slow grind downward. So, because if you expected a big gap up or down, you usually see a smile. The wings would get bid up from the at the money. Here, the wing to the downside is, here's the 12 strike, 129, 118, but we see here the 9 strike, that's the lowest vol at 103. So 29 clicks lower, offered at 30 cents. Okay, so just to give you an example, down 24%. If you think it's going to fall down 24% or more, to hedge yourself beyond that, it's 30 cents, right? You could buy the put. Here's 24% to the upside. Let's call it the 15 strike. It'll cost you $1.10. Just to give you a comparison, of the relative premium you're paying. So,
hey, D, we do have a question. I know we're getting close to 9:30, but Robert was asking, is the preset filter you're using, is that available to everyone, or is that something that you built for yourself?
Well, that one, so let me see. This one looks like I built it for myself. I could make this available. Let me see if I did one. So it's not in here, but I could push this out to, to everyone if you guys want it. But you could see what I up here. These are my filters, and you could fool around with it. You could include open interest in there, volume versus open interest, whatever you want. But this is my starting point to look at.
And also, one of our very active chameleons, Raj, has hopped on. He's on the West Coast, so he's usually not in this early. But he's asking, any chance Dimitri can explain the difference between contango versus backwardation?
Yeah, so that's looking more at the horizontal skew. So that's where right now we're doing the vertical skew. The horizontal skew is when we're looking at implied volatilities that are different going through time. It's like a term structure, we would call it, where you could see here, these are July 9th, July 16th, July 23rd. So you see all these different expirations. They have different implied volatilities as well. So we'll do another show for that, because that will be, that needs its own explanation, the term structure. Right now,
maybe we'll do that tomorrow. What do you think?
Okay. Yeah, we could do that one tomorrow. Right now, let's we'll stick to the vertical one, and I'll give you an example here.
So Brad actually just mentioned that he just copied your filter, so I guess he can see all the highlights in your filter, and he just copied
you could do it yourself. Yeah, you could just copy this, but again, it's a starting point. You could change the implied volatility here. You could do days to expiration. You could go longer dated options. You could go shorter dated options. You could change the option volume, open interest. This is just kind of my starting point that I pick, and sometimes, I'll start changing the filters from here as well. Let me take a look at the wish and give you guys an example what I mean by straight skew. So here we see that the implied volatility, I'm going to use the 12th strike as the at the money. Okay, that's the closest strike to the spot price. And I see that the midpoint, here I see 123 bid, 126.4 offer, same thing kind of in the put, it's a little bit wider. So let's just say I use 124 as the at the money vol. And I'm going to come here to my theoretical value and I'm going to say, I'm going to put a custom implied volatility for all the strikes. And I'm going to say, let's do 124. And I'm going to say, okay. So this is generating a theoretical value for each option using the option pricing model based on implied volatility of 124 for each strike. Okay, so we could see here for the 12th strike, this implied volatility is right in line. It's between 170 and 175. Same thing for the put. Theoretical value is 183. That's between the 175, 190. So I'm right in between. That would be right in between the at the money bid and ask. So what would this option be worth 13 if we ran 124 implied vol? So this option would be worth $1.35. But you could see it's bid 140, offered 150. So it's already above 135. Well, why is that? We see the implied volatility is 127.6. It's not 124, 127.6. So we could see that's already 5 cents. It's bid 5 cents above the theoretical value, assuming 124 vol. And I could keep going here. What if I pick the 15th strike? Well, if we assume that 124 is the correct implied volatility, then the 15th strike should be worth 80 cents. It's bid 105. So that's 25 cents above our theoretical value. Okay, and we could keep going up and up and up. So we could see here, 19.5 strike. If we ran a 124 implied volatility, it would be worth 24 cents. It's 60 cents bid. So that there is, again, like 36 cents above our theoretical value. So maybe you're looking to do a call spread. You could kind of see, oh, well, on a call spread, which ones look good. This is below theoretical value, 124. This is above by 40 cents or whatever, and you could kind of set up a call spread this way, buy one, sell one, right? Let me do the other way. If 124 we use that as the theoretical, implied volatility on a straight skew. So if this is worth 183, I'm going to come down here and say, well, if I ran a 24 vol for the 9th strike, let's say the 9th strike, this should be worth 51 cents, but it's offered at 30 cents. So 21 cents below our theoretical value. Why is that? Because we see the implied volatility is 100.3. It's not the 124, but 100.3. So really quickly, right now, what I did was I see there's an inverted skew. I could run a straight volatility and kind of get a sense if I ran a 124 vol, how far away the market prices are from a theoretical value, assuming a straight skew. We're right up at 9:30, so I just wanted to kind of introduce you to that vertical skew. Hopefully, people were kind of understanding that. If not, send us an email with questions or put the questions in there. We'll try to answer as many as we can.
Yeah, we are getting a lot of positive feedback on it. Things that people didn't even know. It was great, D. Great job. Actually, I didn't even know this website Wish existed. What do you think it's ranked? I was going to put a poll out there. What do you think it's ranked in e-commerce websites relative? I checked it out on SimilarWeb.
What is it ranked? Like in the world or in America?
Like, well, yeah, in the world, 1 through 100.
1 through 100?
Yeah.
I don't know, like I'm looking, it has a pretty big market cap, 7 billion. I don't know, like 50.
13 in
Oh,
in
really?
in,
That
in
high?
traffic.
Wow.
I mean, it gets
So
almost
this
100
would be what,
million. I mean, it's
similar
incredible.
to, yeah. So what would this be similar to, like Amazon or
You know,
a,
you know what? I just briefly went to the website, so I can't actually answer that, but it does look like a lot of it develops off social, and it's kind of like
so
you have to
I went here
register
on
for it.
company info
Yeah.
and I'm looking at similar stocks, so Amazon, so it's in the internet retail space. So
Yeah.
it, that's a familiar one. Um, you know, let me see if I could sort it by market cap. So yeah, here we go. It's basically Wayfair's probably close to it. But yeah, that's something new. I've never used Wish
Yeah.
yet.
This is how you find new things and start developing ideas. Well, great job, Dima, as always. Thank you so much. Chameleons are super happy. It did come up. Raj popped on. His next webinar is July 20th at 6 p.m. We'll start sending emails out for that and registrations. But thanks for joining today, Raj. Everyone else, Chameleons, great job. Thanks, Dima.
Thanks, everyone. Stay safe out there. Have a